Hello, and everyone out there in Facebook land and YouTube land. Thank you for joining us for another Mortgage Leadership Outlook. We've been bringing you these every day at 4 o'clock. And today's guest, I am so excited to introduce you to as a good friend of ours and a good friend to the industry, Mr. Dave Luna, who is the president of Mortgage Educators and Compliance. Dave, thank you so much for joining us.
Thank you for the invitation. How are you today?
Wonderful. I'm wonderful. Listen, all things considered, thank God, my family's good. All the people around me are good. We're going through some really, really ugly times as far as a country, as far as our communities.
Oh, yes.
But as an industry, while we have some rough roads ahead, since you and I are focused on the origination side of the business, things are not bad right now, right?
People's pipelines are full. Rates are cooperating. You're seeing them level out, and they're not bad. Just to let everybody know, rates are even going to get better after we go through this. So quarter 3, quarter 4 for everybody's pipeline. The pipeline are going to be full, and the industry is going to have a phenomenal 2020, taking this into account. 2021, 2022, everything is looking really, really good for the future.
So we know where it's going, and I'm going to dig a little bit more into what you see is going to happen with rates in the future. What's going to happen with products like private label securities with non-QM. But let's go back, because you wrote an article for one of our publications back in August 2018. And talk to us a little bit about that. I'm going to hide myself so I can invite some people actually to this. But please, if you're watching this live, make sure you share, make sure you comment. We want to have your questions. Dave is going to answer your questions live, but just share. Let's get the message out there. And Dave, you take it away.
I was telling people in 2017 what was going to happen in the mortgage industry. People are saying, okay, Dave, what do you see? And data is data. So in 2017, where we're talking about interest rates, we were talking about oil prices, we were talking about stock market, we were talking about appreciation, we were talking about housing inventory, we were talking about all these different kinds of things. And then your publication came to me August 2018 and published everything that I was saying in 2018. So now it's print. Now you can't take it back, right? It's published, it's out there. And then in 2019, people are going, Dave, you nailed it. Dave, you nailed it. And it was over and over and over. And so now as I'm visiting, around the country, and I'm everywhere, Florida, California, not obviously right this second, but generally my wife and I are traveling about 200 days a year. And so I'm in front of tens of thousands of loan officers. So I'm getting a feel from Hawaii to Florida, from New York down to Southern California, it doesn't matter, Texas, wherever. And I'm seeing certain trends and I'm seeing certain things happening. And so we're just sharing with people what we're seeing. And so, California is asking me to do weekly updates of what's going on. So let me just answer some questions before you guys even ask them. Dave, what does my 2020 look like? Your 2020, ladies and gentlemen, is going to be absolutely phenomenal. You think you saw good interest rates at the beginning of this year. You haven't seen them yet. Wait till probably second and third quarter of 2020. Interest rates are going to be fabulous. And then I had somebody, and I don't know whether they were kidding or not. They said, Dave, tell us what's going to happen 3-5 years down the road. Data is data. We are set for the next few years to see absolutely phenomenal numbers. If you guys don't have your pipelines full, something is wrong. Now, I don't mean right now everybody trying to push those 60-day locks and finish up their pipeline. That's not what I'm talking about. I'm talking about things that are going in the future. I mean, we've just added $2.2 trillion worth of additional debt. Well, what does that mean for interest rates? It means interest rates will be low. Interest rates will be low. We are in a recession right now, whether it's a Corona-induced, recession or not, depression, recession, it just depends on length of time. We're in that recession right now. It's going to be, ladies and gentlemen, it's going to be short term. And then when we're out of it, things in our new normal, it will take a while to get back up to speed, but in our new normal, things will be fabulous this year, next 2-3 years. It's going to be difficult, but we're going to live through it. It's going to be really, really good.
So Here's an interesting perspective about this, and I don't know if everyone knows this, but you are an active originator. So not only actually are you someone actually who's speaking from someone who sees about what you say about 50,000 people go through your classes a year,
round numbers, yeah.
So in addition to that, you know what it's like to be in the sit. You know what it's like to meet with borrowers and to go through this. So your perspective is a great perspective. So I got to ask you, what is going on inside of the mind of the borrowers that you're meeting with today?
They're a little bit uncertain, especially if they don't have a job. And you started off being very serious. Let's go serious for just a second, because we have a home in California. And so I grew up in California. We have a home in Northern California. Do you know that 55% of the individuals living in LA County are unemployed right now? 55% is a phenomenally high number. It's bad out there. And on a personal level, my daughter, Andrew, my daughter was diagnosed with cancer and she's going through chemo. Yeah. So, I mean, she has no immune system. She can't go out in public. I mean, if she was to catch this, it would be, terrible. Her husband can't go out. He's got to stay at home with her. I mean, they can't even go out and get groceries because, again, could he bring something back? Not to candy coat it. It's bad out there. But amongst all the doom and gloom I'm hearing, I'm seeing those rays of sunshine. In fact, last week I sat there and said, by the way, this week you're going to start seeing QM come back. Everybody's just looking at me going, what? So you're starting to see, as of today, QM lenders start to come back. Now I'm having private conversations, so I'm not going to mention any names. But those that have already ventured out publicly today, we were telling people last week, yeah, non-QM is coming back. Not as aggressive as what we've seen before, but they're coming back out. They're putting their big toe in the water and they're kind of seeing, okay, what are we going to do? So it's going to really look a lot like conforming, but not for everybody.
Yeah. Well, listen. Okay. So maybe we're not going to see, 1 month bank statements. Maybe not. Maybe that might not come back.
Probably not.
But there are cases where it just makes sense. Listen, one of our guests on this, Robert Senko, he talked about actually it's just skin in the game. It's right. About skin in the game. That's what these non-QM loans are about. And when there is a documentable ability to repay, and there's going to be some skin in the game, they make sense. And another one of our guests said that he was pretty sure that he was going to see a new suite of non-QM products coming back to him as a lender, and where they're one of the largest lenders that happens to have non-QM as their base.
It is coming back. You'll see it a little bit more conservative, and you nailed it when you said skin in the game, because they're not really looking at 80, 90, 95% LTVs. They're cruising a little bit closer to a 75% LTV, but with all of the self-employed borrowers, with all of those individuals in the gig economy, with all of those individuals that just are not square pegs for square holes, there has to be a solution for those good people as well. And there is. And you're going to start to see it as the weeks come out. I can't tell you who it is that we're talking to, but we're talking to folks at the highest levels. I mean, I was talking to somebody and he invited a president from a state to join the conversation. I went, okay, I guess he's a little bit more comfortable in getting that non-QM note out there. So you're going to see it. It will look a lot like conventional to start off with, but these non-QM people are coming back this week. So, people say, okay, Dave, how long before we hit our new normal? I'm telling people about the third week of June, you're going to start to see a lot of normalcy come back to the industry. Then they're asking, well, Dave, what about jumbo and stuff like that? Guys, we got into this super, super quick. However, it's going to take a little bit longer to get out of it next time. But guys, it's coming back. It really, really is. I'm looking at all these people from all over the country starting to make some comments, like Stacy in Connecticut and, other people. I mean, I'm just looking at them. Love you guys. You guys are amazing. Just really, really appreciate all the kind words out there. Anyway, sorry. I'm just doing this when some of these people pop up.
There's a lot of David fans out there.
Something.
There's a lot of David Luna fans out there. There's no question about it. Listen, yeah, you've impacted a lot of people, and something. One of the things we were talking about is your ability to understand the very complex things. Like understanding actually, what actually is happening. Where why the servicers are going to be scared until actually some kind of relief comes from FHFA to address their.
Let's talk about that.
So
that's the elephant in the room right now, right?
Because right now that's the thing. That's
government was issued that liquidity lifeline, right? So in the 2.2 trillion, right here we have hundreds of billions of dollars going, and Jenny says, "Hey, don't worry about it, seller servicers. If you cannot make the payment, we'll cover it for you."
Yeah.
And Dr. Mark Calabria did not offer that kind of a lifeline. So do we think some help will come from FHFA? Honestly, on the record, no.
Really?
Now, where will it come from? It will probably come from the Federal Reserve. It will probably come from them because Dr. Calabria, I know everybody's been beaten up on him, and I'm not going to join that. I'm just sitting there saying his thought process before he became the director of FHFA wanted to cut these guys loose. Okay. Now they're starting to keep their profits, and okay. They have tens of billions of dollars, which isn't really going to be enough. Maybe it will, maybe it won't. No, I don't want to get into that kind of a discussion. But the money, the hundreds of millions of dollars have already been allocated to FHFA. And so all we have to do is look at the owners of the stock of FHFA, right? And that's where you're seeing the senators and the House of Representatives folks get a hold of Secretary Mnuchin and say, hey, we've got to do something. And so it'll probably come from the Federal Reserve to say, you know what? The Treasury, Federal Reserve, we own the stock. And as the major shareholders, this is what you're going to do. So realistically, will it happen? I'm hearing folks on the Hill and conversations going on in back rooms and things like that. Can't share sources right now. But what we're hearing is, come on, you have to. And so a solution will be proposed. Please don't nail me down to when. A solution will be proposed where the GSEs will be able to help. I mean, they own the servicing rights right now. So when you listen to super smart people like Dave Stevens, and Dave Stevens is talking about people the GSEs own. They own the servicing rights. So what happens is you have these smaller servicers that are collecting the payments. You're not going to help them? Of course you're going to help them, but it's just not today. And maybe, and I'm not trying to throw rocks, maybe it is because after, since September 2008, when we put Fannie and Freddie in conservatorship, maybe it's time to let these guys out. And so maybe that's what Dr. Calabria's thought process is. I don't know what his thought process is right now. It doesn't make sense, but maybe that's what he's thinking.
Yeah, listen, we know he has no industry experience. It's all academia. So it's difficult to tell. So we've got some comments coming in here. We got, first off, a little more Dave Luna love. I just took your course, and then the final testing site was closed down. Yikes, sitting around waiting to get fun watching you as I feel I know you. So people actually, whenever they take your test, they always feel like, or they have a chance to interact with you. They always feel that personal connection. Your classes are always engaging. People love that. Then we're going to go to
you guys are nice. Hey, Jack, yes, NMLS does have the testing centers closed down. They were going to open those up. It looks like May 1. If you jump on the NMLS website, they'll tell you when they're going to open back up. So right now, take the next 10 or so days, 11 days, just really, really make sure you understand all of the questions. And so we welcome you into our industry. Jack, we need super, super sharp people. We look forward to having you in. So now we have another Jack. Oh, that's Jack.
So we got my buddy Paul Jones, who's with FGMC. Skin of the game is what has always allowed non-QM to be the right option for many borrowers. We at FGMC offered low-risk solutions for many of the right borrowers, and it will be great when it returns. Amen.
And Paul, it will return again at reduced LTVs, but it'll come back. I mean, it'll come back like you're seeing, like JP Morgan Chase kind of sit there and saying, okay, we don't want to have anything above this LTV. Hey, we don't want to have anything lower than this credit score. And yet I saw just this morning, people were saying, you don't need a 700, you don't need a 680. We'll even pass on 640. We'll go to a 620. So I'm starting to see things, loosen up even right now. So the next month is going to be super interesting. But again, realistically, ladies and gentlemen, let's look at second, third week of June for our new normal. Okay.
Fantastic. So listen, it's difficult to tell what's going to go on with the private labeled stuff, the private lending. So Vince Valvo said this. What do you think will happen with private lending, fix and flip, since that segment is pretty much all but shut down?
So private lending is an individual deciding what they're going to do on their own, right? And so if you have individuals that are just a little curious, what the heck is going on in the market? It's going to be their call, like it's always been, because it's their money. If they think it's a good deal, they will engage on it. What you don't see is the wholesale approach to fix and flip right now. And what's hurting is you're seeing purchase volume go down a little bit. Why? You can't do open houses. You have the Open Doors and the Redfins and the Zillows. That model was for an increasing economy that we just don't have right now. So as soon as the fundamentals are still there. I mean, guys, we were looking at, unemployment figures that we hadn't seen for 60 years. As soon as we all want to go out to a good meal, what are they going to do? They're going to hire those service and hospitality, folks back, and, the other industries affected as well. This is just temporary. And then we're going to go back to see, those unemployment numbers go down. We still have 3.3 million houses that we're just short on. So you are going to still see appreciation. But of the people that are building, I mean, I just got a note today from a loan officer in a different state where she's working with a particular borrower trying to purchase a home. So I'm buying a new house. I'm moving in, in 2 days, right, Andrew?
That's right.
So the purchase business is still out there. It's just trying to get its feet underneath them. I'm glad to see NAR kind of come back and say, let's do virtual open houses. Let's come up with these solutions. So it's very, very cool to see that in this industry, you got a lot of smart people doing a lot of smart things. And again, just sit tight. It's going to come back, and it's going to come back very, very well.
All right. So let me ask you this. You are someone actually, who embraces technology, but you're also an old school person. You're most of your classes, or a lot of your classes, are done, face to face, because let's call it spade a spade. It's still the best way to learn. There's no question about it.
We have all the solutions. We have live. We have webinar with live instructors. We have online self-study. We have it. You know what? It's very, very hard, but this is a record year for us because people are sitting at home thinking, well, I guess I'll just take my CE now. And our numbers, ladies and gentlemen, thank you for feeding my family, and thank you for allowing me to have a mortgage. And thank you. Love you. Appreciate you guys. Thank you so much.
So now let me ask you this. Dave, knowing you're a person who, embraces new technology, but also actually appreciates where we came from, would you have bought the house that you are buying right now if it was only virtual? Like, what would you have actually been able to maybe even just narrow down the selection? I mean, what did you
narrow down the selection? Because when you have the virtual tours and square footage and bedroom and bath, and they can measure the ceiling height, and you can, get the aerial of the neighborhood, and you can look up, crime in the area. You can see how far away grocery, entertainment, hospital, churches, school. I mean, you can look all of that stuff up. It would have narrowed down the selection process. But again, I mean, I've been in this industry since Jimmy Carter was president and interest rates were at 18%. So, but I love technology. I love technology. And it would have narrowed down the selection process. But Kimmy and I actually right after we're done with you, we're going to go see the builder and the realtors and everything, and do our final walkthrough. Can you tell I'm excited?
Yeah.
Can you tell I'm excited?
You're excited. You're always
what are you drinking? Water.
And a lot of it. Yeah. Scotch and water virgin. So I just wanted to bring this up. So when you were talking about the GACs, and what actually is going on with there, Chandra just brought this up. Thank you for saying it out loud, Mr. Luna. I agree with you with your thoughts on GACs.
Chandra, I knew you were thinking it, but I'm just having the opportunity to share it with everybody else. So I'm glad, high five, virtual high five, can't touch, Damon, thank you. It says David makes CE tolerable. Damon, as an originating loan officer, I've sat in some classes that are painful. It's like watching paint dry. It's just awful. Jennifer, love you. I'll only take CE. Okay, guys, not a commercial.
I know, I'm sorry. This is only. I'm putting this up on here because it's
cool. I love it. Andrew, ask me a hard question.
Okay. All right. So let's talk about. So you talked about actually, that we're going to see some areas are going to hit with 55% unemployment, and you're saying actually that we're going to see some of home appreciation in values. Like, to me, and I've heard several people talk about this, and it just doesn't make sense. And I am a public school educated person, so please walk me through actually how we can have such actually an ugly economic situation and still have appreciation in values.
Okay, cool. So all right, so they are not mutually exclusive. Okay, let's take these things together. Okay, why do we have high unemployment right now? Well, we have high employment right now because of COVID-19. Well, COVID-19 will not be with us forever. Okay, so if it isn't with us forever, what will happen when this is now behind us? So all of the information that we had before, we know we have a housing shortage. We know that when people, families are still being created, we're getting older, we're falling in love, we're having kids, and you don't want to have someone above you, below you, to the left and to the right in an apartment. And you want to have a place where you put your own nails in the wall. Okay, I get all that. You want to have a backyard with a swing set and a dog or a cat, right? You either have skin babies or fur babies, right? And so you want that. And so you go out and try and find it, and it's just not there. Or what you want is just now priced really, really high. So now let's put some of these things together. One, if you're in a recession, what is, what's going to happen to the economy? Well, the only thing they can do to spur on the economy is drop rates. And you saw, Chairman Powell do exactly that. And, President says, okay, you got to drop it. The timing, the battle between, Powell and Trump, I'm not going to get in the middle of. Okay, so now we're at near 0 to a quarter. Okay, so we can't drop them further, and this country will never go to negative interest rates like we've seen in other countries. And oh my goodness, wow, the Bank of England, really? Did they not see Denmark's example? Okay, negative interest rates do not solve anything, and this country is not going to do that. Okay. So they're making credit more available. Interest rates are going to stay low. Inventory is tight. If you want to keep your workers, you're going to have to increase their wages. And so because people can now afford more, interest rates are phenomenally low. You now have more people that can qualify for these more expensive homes. And taking all of that together, temporary unemployment, okay, they're going to come back, but you still have the other underlying factors that are just messing things up temporarily. Go back to March 18th. We just knee-jerk reactioned it. And then from the 24th until now, you're starting to see things, level out and return to our new normal. So guys, this is just a hiccup. This is not long-term permanent. We're gonna make it through this. Just a little more patience. We're almost, in fact, you're seeing some of the people saying that, we may be on the downside, and you're hearing talk about, well, we will reopen the economy, by May 1. Well, let's see what the health professionals say. I don't know that I'm all in on that one. I'd love to see it, but I don't know that I'm all in.
All right. So back in August 2018, you predicted the recession, that was going to happen now. So
I was off by a quarter.
Yeah.
But I didn't know COVID-19 back when
Whoever thought actually that it would be a super buster recession.
What was it? One person eating an undercooked bat? Is that what it was? Is that what it was? We could have predicted that.
There's a lot of different theories going around that might not be actually that wet market that everyone was talking about. But let's put that aside from me. So you're good at actually at understanding what's going to happen to the future. You've talked about what's going to happen in the near future. You've talked about actually how this is going to be a great year. Next year is going to be a great year. What does rates look like, long term? Because at some point, do we get so accustomed to ridiculously low rates that if you go up above a 3 or a 4, that it could shut everything down?
Okay, so let's go back. Okay, Andrew, I'm old. I was going to sit there and say I'm old. And when we started, I remember my first refi dropping from an 18%. This guy, rate and term, right, lower interest rate. The guy was so grateful. He said, "Dave, I am so thankful. I never thought I'd see interest rates all the way down to 16%. All right. So that's kind of what's going to happen now. You have a borrower that misses it by an eighth, by a quarter, by 0.5% of historically low rates that no one has ever seen before. And by the way, that's what we're going to have.
Yeah.
I mean, come on. There are some people that you can just never make happy, but this will be a very, very good environment for many quarters to come. So again, everybody is struggling in recession. It wasn't a Corona-induced recession. It was already happening. You were looking at the Eurozone and Asia. I mean, we were supposed to go into this. This just compounded it to the nth degree. And now as we migrate out of it, and ladies and gentlemen, we will migrate out of it. I mean, you're already looking at counties that are, you had 9 states that never had a state shelter in place or stay home. You had 9. Okay. And those governors are saying, yeah, we called it. You now have people that are going out and protesting. Wait, where's my rights? I don't want to stay at home. Okay. So it will relax. Hopefully we don't relax it too quickly. But it's gonna be a blast, And if you miss it, you probably didn't want that borrower anyway. If the borrower was just shopping rate, love them, appreciate them. Let's be truthful here. There are some borrowers that you are friends with on Facebook and things, and there's some other borrowers that you're like, you'll probably be happier with somebody else and let them go somewhere else. You're going to have so much business you can almost pick and choose. It's going to be fun.
I agree. There's no question about it, and it's going to be. It's not just this year, like you said. It's for the foreseeable, 2 years. But so what happens after that? What happens after actually everyone's got? I mean, are we building ourselves up, and creating some big bubble because everyone's going to have rates in the 2s, or whatever that really looks like. So is it at some point
I choose low 3s? You're going to see it day in, day out. It's going to happen.
So then from that, do we shut the mortgage industry down because we've gone through so much? So explain, and we've gotten used to such low rates, such artificially kept low rates, when all of a sudden rates go back to a normal level at like a 4 or a 5.
When we say a normal level.
Yeah. I mean, is this the new norm?
I used to have an employee who was 85 years old, and he's now passed, and God rest his soul and everything. I mean, the lowest he ever saw in his mortgage career at 85 was 4.5. And we're joking. I mean, come on, these are fantastic rates, but they are cyclical. So from an individual that's watched interest rates on a daily basis for almost 40 years, rates go down, rates go up. Will rates go up? Yes. Will they go up by a lot? Who knows? Who's president? What's going on in the economy? Who knows? You will just have people that go, oh, okay, that's the rate now. And if I want to buy that house, right, they're gonna pay the rate. Now, yes, are they going to give up their 2 or 3% interest rates to go into a 4 or 5? The answer is yes. Why? People are still going to have children, and the kids are still going to need braces, and you're still going to get car and insurance, and they're going to go to college, and they're going to get married. People are going to
card
go
debt, car
do
loans.
Yeah. So, I mean, student loan, let's run with student loans for just a second. Student loans are number 2 behind mortgages. They have exceeded credit card debt to the tune of, yes, it starts with the T, trillion, right, in credit card debt. And so people will still do that. And, people will want to finish their basements or get a vacation home. It doesn't matter what the rates are. And for producing loan officers, and you guys chime in, we're live, this is real. Loan officers, when rates were at 6 or 5 or 4 or 3 or wherever they're at, and they moved, if all you do is you're just a rate guy, you're a commodity. It's somebody calling up on the phone. Hi, what's your rate? Hi, what's your rate? Hi, what's your rate? Unless you can differentiate, why should I do business with you? You're going to be stuck in that rate cycle. Do you believe that FICO scores will go back to pre-COVID numbers? Felicia, absolutely, I do. And let's do a point of clarification on this. Okay, so if you look at the CFPB, they've kicked out videos. I think the last one was last Tuesday, where they said, okay, if you're doing forbearance, understand that it's not going to mess up your credit score because your lenders are not going to mark you as late. Okay, so this may be old school for some people, and it may not. When you look at a credit report, you see all of those C's. That means they're current as of that month. The payment was received that month. It's not going to take lenders very long to see a 640 or a 660 or a 680 credit score, but to see a couple of spaces where there is no C, meaning no payment was made. And these guys are pretty smart. They're going to go, oh, wow, they didn't make any payment. So it doesn't matter what the credit score is. They're not going to do the loan because that person was in forbearance. So the question is, why were you in forbearance? If you're still at the same job, doing the same thing, why did you go in forbearance? So ladies and gentlemen, if you can tell your borrowers, don't do a forbearance if you don't need to. I'm actually getting invitations by realtor groups to talk to the realtor groups and say, okay, they're not just calling their servicer because they can't get through on the phone. They're now calling us, the realtor, and saying, Dave, what do we tell them? So there's a big disconnect between the information out there between a forbearance and a deferral. They are not the same thing. So a forbearance, okay, they skip April, they skip May, they skip June. On July 1, they're going to have to make those 3 payments that they skipped and July's payment as well. So 4 payments. This is real. I talked to a borrower who had a $4,000 a month payment. And when they called, they didn't need forbearance, but they just called just to see what the options were. They said, sure, no payment April, no payment May, no payment June. And on July 1, we need $16,000. What? So people don't understand the forbearance.
Someone just lost their job.
Yeah, they just think it's automatically bolted onto the end. It's not. So please, ladies and gentlemen, educate yourself on the difference between forbearance, deferral, things added back into the end of the term, okay, the loan, if they're going to add the 3 months at the end, and then is it a recast? Do I have now 30 years and 3 months, or just what it is that's going on? So educate yourselves, because they're going to be calling you as the expert, and you really, really need to know what you're talking about.
Yeah, I just love this comment from Rob Yo's connecting from Twitter. If they tell me they're calling 12 lenders to shop, I tell them, keep calling. I'm not their guy. Amen.
Rob, that's exactly right. I mean, right now in this environment, and again, I'm not saying anybody to be rude or impolite. And again, if you've been doing this at any time at length at all, you guys are all very kind and very professional and very cool. But just understand, that's probably a bar where you don't want, because you're going to have you have PennyMac. PennyMac is the largest aggregator in the country, and PennyMac is saying, no. If they do this within this period of time, we're going to make you buy the loan back. And never mind EPOs, all right, and EPDs. Oh, good gravy. Those are things we're going to have to struggle with in the future as well.
Yeah. All right. So, what do we do actually to get this message out there? So let's say actually we're originators. We know actually, the dangers of the forbearance, the knowing actually that those 4 months are going to come. There could be a balloon payment. And I know there's other options that lenders or servicers are looking at, but what are some of the things that you suggest for originators to do right now to get this message out there to make sure that their borrowers that they've helped out previously and the real estate agents that they work with, or referral partners, financial planners, accountants, are not making the wrong decisions because they think it's free money?
Okay. One, they need to listen to your show. Okay. To hear, what people are, what they need to be saying. Two, I would go to the CFPB website, because CFPB website is really, again, for consumers, sending out information. They're creating videos, and these are pretty cool videos that are informational and let borrowers understand what the options are. So why don't you, mortgage loan originators, get to the CFPB website, see what's going on from an official source, not someone's opinion. And from that official source, educate yourself so that when they call you, they go, oh my goodness, my loan officer is so cool and so smart because he or she knows exactly what's going on. And actually be a service. Let them know what their options are, counsel them, guide them, let them know where they can go to search. If you want to call servicers and say, hey, what's your plan, and create your own spreadsheet, okay, do that. Call the loans, the borrowers on loans that you've recently done, and have them call their servicers and get that information, compile it. Yeah. Then, ask the local radio station, the TV station to interview you as the industry expert. Now you have all the data. Now you have all the information, and you come off as an expert. Now people are going, oh my goodness, John or Betty or, whoever, these guys know. And if I'm going to do a mortgage, I'm going to talk to that person because the TV is interviewing them. They're smart. They know what they're doing. You can actually be marketing in this kind of, very, very negative environment to just give you a leg up when things come back to normal.
Yeah. And listen, some of these people that are looking at the forbearance options have no business getting the forbearance because they actually have the money. They actually are still have money coming in. So
like you said, it's not free money.
Yeah.
They got to get back. They signed a promissory note.
Yeah. But there might be amazing candidates for refis right now. So yeah, we got Chandra. She's piling on. Thinks that's great advice. We got a comment coming in from a Mr. Joel Berman. I don't know if you've ever heard that name before.
I don't know. Is he like a twin brother, Andrew?
It must be. He sounds like he's from New York. Okay.
Then he's got to be a good guy.
Yes. All right. From Bowl German, we got, do you think some of the technology embraced to overcome some of the challenges caused by COVID-19 will survive into the new norm and be good? So talk about actually, like, for instance, some of the things that we're seeing for adoption of drive-by and desktop appraisals. What are your feelings about those products?
Those things are temporary. And if you actually look, you had, Mr. Tedesco, right, on your show. What was it last week?
It was Tuesday, Thursday, Wednesday. Yeah. One of the days.
These measures are only temporary. So you're getting little hints from Fannie and Freddie. Okay, we're not going to need a 4506T now because, and then you got the IRS thing. So the same thing with appraisals. You have the appraiser show up, strong, healthy, knocks on the door. They got the Bob and Betty borrower have a smile on their face, opens the door, and then he's just got a little tickle. Oh my goodness, they slam the door. We're not going to have this guy come in. So the 2055 instead of a 1004 is a temporary measure. And again, let's clarify, for banks and credit unions only do they have that 120 days where they can get the appraisal after the loan is closed. Never mind what the value is going to be, 120 days from now. But anyway, that's for the banks and the credit unions. So for the other side, mortgage brokers and mortgage bankers, it's just temporary. And they are showing you that, let's relook at this again here mid-May. Let's relook. You're going to see, how are we doing? Should we now change it back to the way it was? And ladies and gentlemen, it will get changed back to the way it was on appraisals. So the first part of Mr. Berman's question was technology. Will we still have those? Absolutely. So I think Zoom was hacked, and it was embarrassing because you had kind of a school class and a teacher, and then you had somebody kind of crash in and do something unsavory. Okay. So I think Zoom's going to tighten up a little bit more. Plus, you're seeing other technology go out there. Will those continue and enhance and grow and get better and become more secure? Absolutely, yes. So here's a funny thing. The very, very, very first completely paperless, completely electronic mortgage done in America, the first one. Andrew, do you know who the loan officer was on that one?
I know where. So I know it was in Utah.
It was Dave Luna.
I had no clue. So I knew it was in Utah. I knew it when it
I
happened.
did that. So we did that. It was very, very cool to watch. And so the question is, one, when was that done? That was done in 2000. We're in 2020. What is going on? I think maybe for some of us, we don't want to let go of paper. Yeah. We have to. The new generation, it's not paper, folks. It's that handheld device. And I've got my own concerns about that. For example, when you go to sign your documents, you just click on it, it scrolls down, you click on it, it scrolls down, you click on it, okay, you're done. What did they read? They didn't read anything. So will technology replace the loan officer? The answer is no. There will always need to be someone to explain what in the heck is going on. What do I qualify? I mean, we had borrowers. I'm still a producing loan officer. We had borrowers. And the borrowers, we had the gentleman and we had the wife, how much do we qualify for? So they wanted to know. I mean, okay, we're looking at houses with our realtor. What about this? And what about that? And is there down payment assistance? There are some handholdings. A lot of folks are like, hey, if I can see a YouTube video, cool. But if I don't get it on YouTube, can I call you? They want a mesh of high touch, high tech.
Yeah.
If you can offer both high touch and high tech, you've got this thing won.
Yeah. So, I mean, but the actual closing process, if we were to be paperless, I think actually it would allow for things to happen a lot more efficiently. Like in New York, you need, you need a team of attorneys to close actually a loan in New York. So you have certain states actually where it becomes actually a major cost, that blocks people from maybe hitting that point that they can afford a home. But I think a lot of these technologies that we are adopting, such as actually going digital, are definitely a thing that's better for us. I agree. People do want actually physical. They want hand holding. But listen to your point. Actually, did you ever read the terms of services when you agreed to sign iTunes and you go through that? I know most people don't. I also know most people for my real estate transactions, whenever I've been there, my attorney just said, "Listen, just sign. I took care of it." Right? I'm just like, "Yes, you got it." Then you just sign. So it's whether it's digital or whether it's in person, I still think it's going to be the same thing. No,
you have about a state a day signing on like RON, remote online notarization.
Yeah.
It will not be too long before they will have the entire process end to end. In America, you got 3,800 counties, but in reality, only 380 counties do about 80% of all the transactions in America. Wow. You get those 380 counties on, you pretty much got all of America. No, you won't have Chumbawamba, Alaska on, and no offense to Alaska, love you guys.
Or the great people of Chumbawamba. No offense.
So I made that up, Chumbawamba, right? So you may have somebody, a registrar or county recorder that still wants their number 2 pencil. All right, hang on. Can I see the little squeezy notary? Okay, fine. You're still going to have those, but the lion's share will change. Ladies and gentlemen, it's the future. The new people moving into this technology, most of the transactions happening are by these young, smart, educated, wonderful people that say, well, wait a minute, I can do everything else on my device. You mean I can't close my loan? It'll happen. It really, really happened. And for the audience, ladies and gentlemen, get yourself up to speed on what's going on with MISMO, MISMO, the Mortgage Industry Standards Maintenance Organization. Please, please, please be aware that the major issues that have happened in the past are no longer issues. You have a lot of smart people that are moving forward with how do we make the real estate value chain, the entire life cradle to grave thing, make it online and digital. Again, you are not being kicked out of a job. Your job will just change. So when you think about it, do we have town criers giving us our evening news? No. Do we have switchboard operators? No. So you don't got some guy with a box ringing a bell, hear ye, right? We just don't do that. And so industries change. And if we don't change as well, we're going to be left behind. Sorry, that's just how it is.
So what are the few tasks that a loan originator did, let's say, in 1980 when you got into the business, that you probably will do in 20 years when you're still originating? So in 20 years, actually, when you're still originating, what are the 2 tasks or 3 or 4 tasks that you'll be doing then that you're doing today that you did in 1980?
They don't care how much you know until they know how much you care. Do you really, really care about them? Are you just, and this is no offense against Burger King, hi, may I have your order, please? If you're just an order taker, you will be replaced. So short story, I teach a lot in stories. So my neighbor across the street, won't be my neighbor for very much longer, but my neighbor across the street, Don, came in to see me. And when Don came in to see me, we were just talking mortgages because he knows what I do. And so I think my job is to present to Don options. So I presented to Don an option that he absolutely got angry with me. I mean, his face turned red. He looked at me and he was mad. And I thought, oh, great. He's my neighbor and I've just ruined a friendship. Oh. And I said, hey, listen, go home, talk to your wife, but I want to tell you how I came up with that third option. I said, Don, in the loan application, I know how many kids, I know their ages, I know what you're doing. I'm seeing that you're going to be an empty nester. I see that you're getting older. You probably want to pay this thing off. And so that's why I presented this third option to you. But listen, go home. If the first option, which is the reason why you visited with me in the first place, is the route you want to go, cool. We'll do that. But I think this one's best for you. So we went home. Next day, hey, Dave, yeah, we're going to go option 3. Don, yesterday you wanted to rip my head off. He says, Dave, what you did was you brought things that I didn't even think about. If loan officers, if mortgage loan originators, if the industry will just be that smart, educated, professional person giving the borrower options, you can't be replaced. You can't be replaced. So, Andrew, let's turn this around. You're going to go get, surgery done. Let's say LASIK or whatever, right? And you go to see the surgeon and sorry?
I need that too. My eyesight's going. So continue.
So, who do you think gets paid more money? A generalist or a specialist? So if you can become a specialist, I think Barry Habib calls it an advisor, right? I think if you can set yourself apart from everybody else and absolutely care about people and spend the time to invest in them and give them options so that they think about, you're never going to be replaced. You now are the specialist. And I think if people start thinking that way, they're going to differentiate themselves from, piles of rocks. You have the consumer. How much is your pile of rocks? How much is your pile of rocks? How much is your pile of rocks? And if all you're doing is selling rate, going back to a previous question, that's it. You're just rate, right? That's it. You're just a pile of rocks. Excuse my French, ladies and gentlemen. I don't mean to offend. You have to differentiate yourself. I've closed thousands and thousands and thousands of loans. I think in my career, I've closed about 7,000 loans. So from the old dude, I'm just giving you some counsel. That's how you differentiate yourself. Work really hard. 3 things. And sorry, I'm going to take the stage on this thing. 3 things.
Please.
You work really, really hard. When you're at home, turn work off. Be with your family. That's what's most important. And then to keep you very, very level and look at those three things, and if you build on that, you're going to be extremely successful. Give back. When you work really hard. Do not rip off your employer. If you're the owner, you're not going to rip off yourself. Work really, really hard, but know when to turn it off. 2, when you're at home, isn't this why we do what we do, is for our families? Okay, so absolutely give them all the time that that they deserve, and then give back. Whatever that means to you. If that means your church, if that means your community, soup kitchens, whatever that means to you, give back. And then what happens is I think your head doesn't get screwed up because you're making so much money, right? Then that foundation is absolutely rock solid, no matter what COVID-19 or interest rates or the economy. It just doesn't matter. Whatever you do, you're going to be great. And please, from a 40-year guy, hey Jason, how are you, my friend? Just if you can just do that, I think you'll be happier. Anyway, I've been married to the same woman for 40 plus years. If you know me, you don't ever see, except right now when I'm with Andrew, you don't see me anywhere without my wife. She is the greatest. She's the sweetest, kindness. If you guys know my wife and you know how Dave and Kim are always together, Andrew, personal story, her name's Kimberly. What ticks me off is when people call her Kimmy. I call her Kimmy because she's my wife, right? And so, but in an audience, of 100, 200, whatever people, they hear me calling my wife Kimmy. They go, oh, her name's Kimmy. So they call her Kimmy. And I'm thinking, wait a minute. That's not cool. So then I thought, okay, what should I call her that nobody else would call her? So I call her Princess, right? Mm-hmm. Now, the rest of America calls my wife Princess Kimmy, and I just give up. I just say, all right, hey, it's Princess Kimmy. Jason, love ya. I try really hard to know my stuff, but hey, Jason, kudos to you as well, my friend. Okay.
So I'm gonna, we're almost hitting an hour, but I want to ask you this one thing. So you were a regulator in Utah. You were an originator. You own a really, really successful and loved educational company. If you were able to make any amount of money and have actually job satisfaction, but you could only do one of those three things, and your the income would be the same, which of those three things would you do?
Work, family, and giving back.
No. So between actually, when you originated loans, what you were, which you're still doing today,
right. Love doing that, by the way.
I know you do. I know you've got a passion for that. Having the education company, or back when you were a regulator for Utah. So you could do only one of those.
I can only do one. You can only do one,
and the pay is going to be equal. So whatever it is, you're going to make $500 billion a year.
I'd still do education. I'd still do education. One, as a regulator, sometimes you ended people's careers, and that was sad. And so I serve at the pleasure and will of the governor. So when the governor changed and you had a new governor, I got a new assignment. And my assignment after being commissioner was, Dave, we want you to end chronic homelessness. That was cool, And so regulator, okay, fine, cool, whatever. But ending people's career, not really fun. So I wouldn't really miss that. Origination, I can get the charge out of visiting with you guys. You guys are talking about, well, we got this builder and they're doing these incentives and I can't compete with the incentive. So Dave, how do I keep the loan that I've been working with this bar with for months to get the down payment up and get the credit score up? And, I've been really, really working with them, but now the builder is going to do a $5,000, $10,000, $15,000, depending on the price, incentive. How do I do that? Oh my goodness. Let me do a brain dump. Let me tell you how to walk through that transaction. And then I get a charge when they come back and go, Dave, I saved the transaction. That is what's cool. So I take my 40 years and I can put it in your brain so that you don't have to do the same thing I did. You're not making the same mistakes. Oh my goodness. Marketing and overcoming objections and solving problems. Are you kidding? And then I get paid on top of that? That's what I would do.
Wonderful.
Christy, love you. I'm just seeing these things pop up, and it's very, very cool. Sorry, it's very, very cool where you just see everybody. Yep.
Wonderful. All right, Dave. Always great to spend time with you, and I really appreciate you giving us some guidance, giving us some clarity, in these crazy moments, and giving us some things to be excited about. I mean, I got to say, like, I'm not just excited about what's going on right now. I mean, health wise, we've got some things to overcome. Policy wise, we've got some things to overcome. But from a business standpoint, there's going to be some great times ahead, and we really, really just love having you as one of our leaders to be out there sharing your guidance.
All right, you're welcome. Thank you.
And someone's asking you to do a builder challenge. Sounds like an inside joke, an inside.
Okay, so everybody understands. Okay, I mean, just for tuning in and they figure this thing out and it saves them a transaction, you should charge for this. Okay, ready? Do not do it the wrong way. This is how you do it. Everybody pay attention. We got just a few seconds. So I'm only going to say it once. Do not send me an email because I will not repeat it again. Here we go. You work with your preferred realtors, and that's a whole different conversation right there, how to get preferred realtors. So you work with your preferred realtors. Now, train your realtors what to do before they go into the builder's office. Prep your borrower as to what's going to happen before they go into the builder's office. Many builders, and I was walking in there, the shops, I won't mention any names, they saw a slow winter, but they're seeing that springtime, it really picked up in January. Moving on. They have many signs that if your realtor doesn't show up on the first meeting, they're not going to get a commission. So realtor and borrower go in the door on the very, very, very first meeting. Okay. So they like the Hayward model and they like lot 173. And now it comes time for the contract. Okay. So the person behind the desk starts doing the contract, and I won't mention any names, but it's usually item number 5. I've done this so long, I've memorized those builder contracts and where to find it. So number 5, hey, we're going to offer an incentive of 5,000, 10,000, 15, whatever the number is, right? But you have to be pre-qualified, pre-approved with our builder-owned company, or you don't get the front yard, you don't get whatever. No. Now, this is where the realtor comes in. Realtors can and often do modify contracts. We'd like to have the incentive. We're crossing this out, line it before the borrower signs the contract. Here's the problem. You guys are calling me and you guys are sending me emails and you guys are saying, Dave, what do I do now? Well, after the contract signed, folks, that leverage that you would have had is gone. Now, my dad was a builder. My dad was a builder in Southern California. So from the son of a builder, honestly, truthfully, what does a builder want? The builder wants to know if they're agreeing to Bob and Betty buyer buying that house, that transaction will go through. Now, many in the past have been so screwed over, excuse my French, they've been so messed up by people doing these pre-qual or pre-approval letters that wasn't even worth the paper it was written on. They want to make sure that that thing's going to close. If you can satisfy their concerns that transaction is going to close, builder, we pull credit, we verified income, it's gone through underwriting, whether that means DU or whatever, right? We are good to go. It's subject to appraisal and title. This thing is going to close. We want the incentives. You'll get them. And don't tell me that you won't get them, because I've gotten them over and over and over from different builders. Okay. Don't tell me it doesn't work. It does work if you do it this way. If they say that, if they sign that contract first, you haven't trained your borrower and you haven't prepped them with the realtor when they go in. When they go in, right? I mean, trust me, it'll work. I was going to share a story, but then it would sound self-serving, so I wasn't going to do it.
Well, listen, this is the great thing about doing business with you. This is a great actually reason why people love your classes, why people love your online training. This is just because of actually the value that they get beyond actually, just learning the minimum required, things to be able to continue to do great things in this business. Dave, I can't say enough great things about you and how grateful we are actually to have you. And just thank you so
You're
much.
very
Please
kind.
stay
You're
healthy.
very kind.
Please
You will. You
send
will.
my love to Princess Kimmy.
I'm used to it now. I'm used to it now.
All
Anyway.
right.
Hey, thank you, everybody. Appreciate everybody else. Stay healthy and strong as well. We're going to make it through. It's going to be great. So love to all of you guys. Have a really, really fabulous week. It's going to be a good one. This is going to be a great, great week. Watch out for numbers coming out Tuesday and Thursday. But other than that, it's going to be a very, very, very cool week. Thank you, everybody.
Fantastic. And everyone, I'm Andrew Berman from National Mortgage Professional Mortgage News Network. We've got some great shows coming up later this week. So tomorrow, Christine Beckwith. So excited for that. She's going to be coming up tomorrow. Then let's see, Robert Stevens from GSF has got some great actually ideas on how you can have positive messaging using video. Let's see, Thursday, I believe we have, that's right, David Schroeder, the head of TPO, a hero of wholesale for Caliber. So excited, got some great stuff. Thank you for everyone for sharing this and joining us. Please, we hope actually we're giving you some information that you can share with your community, with your employees and with your staff. So again, on behalf of National Mortgage Professional Magazine and Mortgage News Network, thank you for watching.